Thank you all very much for joining us this morning. My name is Steve McMenamin, and I'd like to welcome you to today's session, which is part of the continuing series of the Greenwich Roundtable. Our topic this morning, myth-busting, popular delusions, and the variant perception, is a continuation of our look into crowd psychology. The inspiration for today's topic initially came from Phil Zecker when he described one of the educational goals for his investment committee is myth-busting. And as we started digging in, it seems that not much has been written since the Scottish journalist Charles Mackay wrote Popular Delusions in 1841. And 20 years ago, George Soros wrote the secret to his success was trading on the variant perception that came from the reflexivity of the crowd. And today we're very, very lucky. We've managed to persuade three of the leading lights, the best in their class, to dig deeper into the mind of the crowd. They need no introduction. I'll try after I say this. The speaker's views are their own and don't necessarily reflect our views, and our lawyers are very happy that I've said that. So, in reverse alphabetical order, for the first time, he gets introduced first.
That doesn't happen very often.
Jason Zweig, spelled Z-W-I-G, is the investing columnist for the Wall Street Journal and an old friend of the Roundtable. For over a decade, he's shown us how our mind works when making investment decisions, both as individuals and in committees. He's helped us avoid a lot of mistakes, which in an efficient market can help protect us from ourselves, and also allow compounding to work its magic. Before the Journal, he wrote for Money Magazine, Time Magazine, as well as an editor at Forbes. Zweig's written 4 books that are required reading: Your Money and Your Brain, The Devil's Financial Dictionary, and The Little Book of Safe Money. Most importantly, Jason edited the revised edition of the best investing book ever written, Benjamin Graham's The Intelligent Investor. Zweig sits on the editorial boards of Financial History Magazine and the Journal of Behavioral Finance. Sitting next to Jason, Victoria Ivashina is a professor of finance at Harvard Business School and an old friend of the Roundtable as well. Professor Ivashina is the faculty chair of the Global Initiative for the Middle East and North Africa, a research associate at the National Bureau of Economic Research, and a visiting scholar at the European Central Bank. Victoria's research is remarkably congruent with the Roundtable's mission, where she examines private markets, venture capital, asset allocation, and the value creation of buyout firms. She's recently written a book on one of my favorite subjects with Josh Lerner called Patient Capital. I've just ordered it, and I recommend you do the same. Michael Mobison, sitting next to Victoria, is the head of Consilient Research at Counterpoint Global and an old friend of the Roundtable as well. He first opened our eyes to the paradox of skill and the wisdom of crowds almost 15 years ago. Before Counterpoint, he worked alongside Bill Miller as the chief investment strategist at Legg Mason Capital, as well as serving as the global strategist at Credit Suisse, joining that firm in 1992 as a packaged food analyst. Michael's the author of 4 important books that should be on all of our shelves: The Success Equation, Expectations Investing, Think Twice, and More Than You Know. Mr. Mobison is the chairman of the Santa Fe Institute, and he's been an adjunct professor of finance at the Columbia Business School since 1993. And finally, the moderator of the Greenwich Roundtable is John Griswold. John is the chairman of the Roundtable, the founder of the Common Fund Institute, the Common Fund Forum, the Endowment Institute, and an expert on investment government. And John, she's all yours.
Thanks, Steve. As Steve said, our panelists today really need no introduction, but I'm glad we got one anyway, so remind ourselves how many times they've been here, how many wonderful topics that we've been able to get them to talk about. So we're going to get right to it in a moment. But I want to do one thing, and that is if you have, along the way during this morning's talks, if you have your own idea of a myth that just is burning in your mind, please raise your hand at the appropriate time, and we'll get you to tell us what you think about it, and then perhaps the panel can comment on it as well. This is an area that is a little different from the standpoint of the Roundtable in that it perhaps doesn't point to a particular investment opportunity, But what it's really doing is talking about some of the risks that myths and popular delusions generate in the process of investing. And we'll touch on various asset classes and strategies that illustrate what we're talking about here. Part of the research that we were doing turned up a lot of interesting tomes and ideas about myths and delusions and, of course, variant perception. Basically, of course, myths are usually unfounded narratives or false narratives, if you want to call it that. Would be one definition of it. But they're usually based on something historical. Most of you took a course when you were in college or school on great Greek myths, Edith Hamilton's wonderful classic tome on classical myths. But in fact, myths grow up very quietly and spread out like wildfire in places, and then something will happen to make everybody realize that it was a myth or it was a popular delusion. And Steve referred to Charles Mackay's famous book in 1841. But even he was subject to some myths that were later exploded. Today, myths and delusions are actually fairly widespread. I was fascinated by one book that I found called Jackass Investing. I don't know if you ever had a copy of it, but if anybody would like to thumb through it later and remind themselves what it says, it'll be right here. Michael Deaver was a trader in Wall Street, and having thumbed through, he has 20 myths that he tries to explode, but having read a few of them, I disagreed with almost all of his conclusions. But in any case, today's myths are not hard to find, or at least there are people who claim that these are myths, but some of them ring true, some of them don't. We're sitting here in Greenwich, Connecticut, and in one sense at least, the old myth that house prices never go down is being exploded as we speak. Another one, perhaps, we had a session on cryptocurrency. Is it a myth that cryptocurrencies will not be the disruptive force on fiat currencies that so many predict? We don't know, but time will tell. But with that brief introduction, I want to turn to Jason Zweig, who's going to open the session with his thoughts on myths, delusions, variant perception.
Yep. Great.
Thanks,
Thank
Jason.
you, John. And thanks to all of you for joining us this morning. So John said something that I want to just riff on for a moment that I wasn't expecting. He said that, myths tend to sort of arise in reference to a historical event and kind of percolate and bubble and spread, and then eventually they get busted. Or not. And I think the or not is key. Another generalized quality that myths have, I think, in human history is that they're very persistent. And they can be very difficult to disprove and to eradicate. I mean, think of two things that are fairly well known in Western culture. They popped into my mind immediately when John said that. So one is the fairy tale of the emperor's new clothes. So somebody can appear in public stark naked and parade in front of the entire empire for an extended period of time, and nobody will say anything until the impertinent little child blurts out, "He's not wearing any clothes." That happens quite often in financial markets. It happens often, and it can happen for a protracted period of time. The second image that popped into my head from culture is the famous painting by Peter Bruegel the Elder in the Royal Museum in Brussels of the fall of Icarus. And if you can't visualize it, some of you may remember it from the poem that W.H. Auden wrote. And the fascinating thing about it is Bruegel shows Icarus, who, if you remember your Greek myths, flew too high toward the sun, and his wings made of wax melted, and he fell into the ocean. And the way Bruegel portrays this is with two tiny little feet splashing almost unnoticeably into a vast ocean while absolutely nobody pays attention. And that's the other way myths can disappear, is they can disappear through amnesia. And that prevents people from learning a lesson from them. Human beings are very good at retroactively revising their own beliefs in a way that protects them from concluding that they were wrong. And that's something that we all need to guard ourselves against as investors. So I'm just going to throw a few things out very quickly. One would be, this I guess would be my first nominee for a myth that's potentially harmful, is that it makes sense for many, maybe even most investors to use index funds for their allocation to large cap U.S. equities, but most other markets, all other markets, some other markets are inefficient, and that's where you should employ active management. The problem I have with that is that I think people define alpha in a kind of strange way. They might define it statistically. They might define it through sort of a fairly complicated algorithm in their own minds. I think in practical terms, what alpha really means can be defined with a really simple equation. It's how good you are as an investor divided by how good all other investors are minus cost. And the key question to ask when you're considering active management in other asset classes besides large cap U.S. equity is, how much more do I know than all the other people looking at investing in this area? And how much more am I willing to pay to execute that strategy? And with the advent of index funds and ETFs, and they're spread across virtually every asset class, that's become a much higher hurdle than it was 10 years ago. Now, if you're looking at, say, micro caps or high yield or private real estate or private anything, then you have a pretty good argument that active makes sense. But otherwise, you have to look at cost, and you have to put it in the context of that simple equation. And I would argue that people vastly overrate their ability to come out on the right side of that equation, irrespective of which asset class you're operating in, assuming that it's in the public markets. The second myth, I think, is the supremacy of private markets. And obviously, Victoria will talk quite a bit about this as well. What I hear over and over again when I talk to institutional investors is, we have an actuarial hurdle, whatever it might be, 6.5 to 8 or more percent. And we need a higher return than the public markets can provide. Well, the God of markets doesn't care what return you need. And you are not going to earn a higher return in private markets because you need one. You will only earn a higher return in private markets if they provide one. And the mere fact that everyone you know and everyone you compete against is rushing into private markets as fast as their little feet will carry them should give you great cause for concern. I mean, this is a word cloud. I don't know if everybody in the room can see it, but this is a word cloud of the free-form responses to a survey that was just done by NC PERS, which is basically the National Trade Association for public pension plans. And they asked people, other than public securities, what are you investing in? And as you can see, the single most popular word in that free-form response was private. Private equity, private real estate, private credit, private everything. So maybe these people will all be rewarded for all doing the same thing at the same time. I'm very skeptical, and I think that is highly likely to turn out to be a myth. Another simple one, which we don't hear as much as we used to, is that there's a premium return available in emerging markets because emerging markets exhibit higher GDP growth. Faster economies will generate higher equity market returns. People have been debunking this myth for over 20 years. I think they're finally making a little bit of headway, but if you ever meet with an asset manager who is saying that the expected return on this emerging market portfolio is higher because, as we all know, GDP growth is so much higher in emerging markets, you should be very skeptical. I guess the final myth, and the one that's most likely to offend the people in this room, is that there's such a thing as smart money and you are it. I think the distinction between smart and dumb money is largely a myth. There are people who have more money and there are people who have less money, but smart money is money that knows it doesn't have all the answers. And dumb money is money that thinks it knows all the answers. And it's very important to question your own superiority if you are to have any. So that's all I have to say.
Thanks, Jason. With that, anybody else got a myth along those lines that they'd like to offer at this point before we go on? Good. Well, you've certainly been given us a provocative opening, so I'm going to turn to Victoria for her comments on her specialties.
So I'm going to be talking about private equity. And private equity is a broad term that actually entails venture capital, growth equity, buyouts, distress, at the very least, right? I'm not talking about private debt asset class or anything else. So with that in mind, I wanted to make 2 points. The first one is the one that you're all familiar with, and I'm going to quote. That is that private equity profits come from saddling companies with huge amounts of debt. And most recently, that topic's been elaborated on in November of the past year when there were congressional hearings on the private equity industry in the light of Toys R Us and several other bankruptcies in the retail sector. So you a sophisticated audience, so you probably might be able to answer that question very quickly, that profits in private equity do not derive, or returns in private equity do not derive out of that. But let me ask the same question to match the sophistication of this audience. So we are in the expansionary credit cycle. We've been in the expansionary credit cycle since 2008. And the question is, as the credit cycle expands, the level of debt in the private equity, and let's be specific. So first of all, that entire point about private equity is about leverage, misses the fact that neither venture capital or growth equity are heavy on leverage. Even growth equity, which kind of escalates toward mid-cap companies where the debt market becomes larger, The leverage there is about 2 to 3 times of EBITDA, which is the leverage of a public company, right? So that argument already doesn't apply to those two strategies or to this distress, right? So we're exclusively talking about buyouts. So the question for you was, as the credit cycle escalates and leverage does increase, so buyouts have higher leverage, does the return increase? So if you believe that the leverage is the source of the returns, then as the leverage escalates, the return should be going up, correct? And the answer is, of course, it doesn't. So just to be clear, higher leverage as of right now as compared to 2008. In 2009, 2010, when the market starts to pick up, the leverage in buyouts was about 4x. Right now, it's hitting for the 6, and that's like measurable one. The hidden one is probably even higher. Will the return be high as a result of that? It won't be. So let's take a step back and just think about how can you possibly create returns, and let's be very specific, risk-adjusted returns. Now, if you believe that there is somebody out there who's willing to pour billions of dollars into this industry because it's in access to leverage and pay 2 on 20 just for access to leverage, I mean, that's a separate point. If there is somebody out there that in this massive amount is willing to pay just for the fact that this is access to leverage, I think that would be a miss in itself, right? So let's be clear that most of the limited partners actually understand that there is a risk adjustment, and this is about risk-adjusted returns. So how debt can be a source of risk-adjusted returns? Now, the beauty of finance is that it says to you, you have to name me friction in the market for debt to originate the returns. In absence of frictions, that is not a source of risk-adjusted returns. Right? And the most common one is, and the simplest one, of course, is the tax shields, because that generates tax shields, and that is real money. You pay less taxes, so unambiguously that would be higher return if you get it. So let's now think about, can you get that return through tax shields? So you get to pay less taxes. Who gets it? And the answer is that the companies get it, the target gets it. So as the leverage goes up, and there are a couple of studies on that, and if you line this up with the premium that is being paid for the companies, that tax shields get straight into the price that you're paying for the companies. Why? Because if you think about a large cap company, pick your favorite, KKR, Carlyle, Bain Capital, Blackstone, TPG, et cetera, et cetera. Do you think that any of them have a differential access to debt? Can one of them get more debt than the other? Probably not. This is a very competitive leverage loan market. They all get exactly the same amount of leverage. Not to mention that the sale process in itself is sophisticated, and any company should have staple financing to start with, which would lever the level of leverage that they can all take, right? So now if everybody gets the same amount of leverage, and it takes no skill to receive the tax break from the interest rate, then that return should be factored into the price. Because, as Jason pointed out, the alpha is realized for the differential skill. It was your skill divided by the rest of the skill, so alpha is for differential skill. Once you got the same amount of debt, it takes no differential skill to receive a tax break. And so, not surprisingly, it gets factored into the price. And so what we see is that as we go through the cycle, the leverage increases, but so do the valuations, right? So we all very well know that the valuations are very high in the industry, and this is partly the fact of that leverage being hammered into the price. Now, many of you know that in the background there is also this weakening of credit standards, and this has been an important topic of thinking about what's going on with credit standards in the leveraged loan market, and the reality is that there's quite a bit of loosening of covenants and the prevalence of covenant light and baskets and carve-outs and whatnot. But I would think about that, and that could be a source of value because it gives optionality to the company to restructure. It gives the buyout companies, ability to carry massive amounts of debt. But I would argue that that's just an offsetting force for higher and higher and higher leverage. So I think that at the end, that entire point is a wash. When you think, as a result of that, when you think about the private equity industry, it's very naive to think about, and buyout segment in particular, even buyout sector where the leverage is indeed very high, it's very naive to think that this is an industry that is somehow profiting from the credit cycle. So that's point number one. Now, second point goes to what Jason raised, and that's more reflecting on what should we expect out of the returns in this industry. Now, My point, however, is going to be slightly different because I do endorse the supremacy of this asset class. So, but it's not about that. It's about, will the returns be as high as the limited partners expect? Actually, we already know the answer partly, right? Because we are sitting on unprecedented amount of the dry powder, meaning undeployed capital. So now, if you think about what it means, now, the way we calculate returns on private equity is on the cold capital. Of course, if you committed a certain amount and only half of that is deployed, and internally your return is already being played down, right? So if you factor in the capital that is sitting on the side and think about the return as a combined return, then we already know where this is going. So the problem is that in history, if you think about private equity history, cycles that led to higher amounts of capital being raised all led to contraction in returns. Most recently, it was a cycle that was going on before the 2008. Now, what we are facing right now is an unprecedented cycle, right? It's an unprecedented because the industry basically was doubled. And even though the industry is smart and everybody understands that you cannot put double the same strategies that you were doing and realize the same return, so as a result, things like private debt were invented and blown up significantly. But still, the industry had seen this massive inflow of money that we already see many indications that it's very, very hard to deploy. Now, the concern for me is that we can all understand this point. Nevertheless, when you go to the pension funds, and if you just aggregate the way, how they must, if you try to back up the returns that they must be projecting for the alternative asset class, to put that allocation into the alts, just in a simple model, just thinking about like portfolio and combination of correlation, the result that you will get is that they are thinking about in historical terms. They're thinking about the forward return on this asset class, that you just double in size, and you never succeeded in that, even if you were trying to increase little by little. Nevertheless, that it seems like all that capital is projecting that they will get that return. Now, as a final point, I just wanted to go back to the formation of what leads to the formation of these delusions. And I'm gonna not be as poetic as Jason, but so the first point about leverage is just misunderstanding was an asset class. And it is a different asset class from many others. And so as a result, there is just several myths, and in particular this one related to that misses something fundamental. I think that another cause of formation of myths, which is much more important, and that's the one that relates to the second point on the returns, is that this asset class doesn't have a quick correction mechanism. Unlike a public market where there is a feedback, you learn. You do something dumb, it corrects you. In the private asset class, it takes you 10 years or more to learn that you made a mistake. And so between that and between this very bilateral fundraising, everything is done in one-on-one transaction. There is no aggregation mechanism through the market force because we are dealing with a liquid market. And there is also no aggregation mechanism in information because the way the industry is structured is a very divide and conquer situation. And so as a result of that, these mistakes, as the ones that I'm illustrating, where you think that you can double the industry. Of course, people are not thinking that they're doubling the industry. They're thinking they're special, and they're forgetting that behind every closed door, the same thing is happening, right? And so as a result of that, there is no immediate price impact, and there is no immediate learning from the fact that we are all doubling the industry, and there's not a way that the return can stay the same. That's all I have to say.
Wow. Thank you, Victoria. I assume that your book covers these issues and others.
I should have plugged in my book. You're absolutely right.
I'll give you a full plug here.
It's excellent.
So there you go. I'll leave it at that. The book that actually touches on this last point that I raised about the fact that the industry has the private equity industry has its imperfections on both sides, on limited partners and on the general partners, that kind of contribute to the fact that there is no aggregate learning. There is inability to kind of think about it as a broad asset class and a broad force. So the book makes this point and illustrates, gives many examples of the imperfections on the limited partners and on the general partner side. Thank you.
Thanks. Michael?
Well, good morning. By the way, I did read Patient Capital. I
Thanks.
loved it, so I would definitely highly recommend that. Let me say it's a real pleasure to join you today. These roundtable sessions for me are always great because they prompt me to organize my thoughts on some very important topics. And this morning's topic, I think, is a super fun one because it does provide an opportunity to critically examine some issues that I think are often understood or discussed very superficially. I'll just mention, I think Steve alluded to this, but I should mention that I first participated in a session with a roundtable 15 years ago, and I was on a panel with the very great Peter Bernstein. You remember that, Steve? So, and I said, my opening comment was, I said, when I grow up, I want to be Peter Bernstein. And 15 years later, what I can say is I've aged a lot, but I certainly have not grown up at all. So now I'd like to address 3 myths. The first one relates to short-termism, and you hear a lot of fretting about the deleterious impact of short-termism without a lot of concrete evidence for its existence. So I'd like to examine some of the arguments there to see if they do hold water. Second one is the idea that dividends play a large role in equity returns over time. And I'm going to demonstrate that price appreciation is the only source of investment return that increases accumulated capital. And the final one is that the idea that investing in money-losing companies is a bad idea. Now, it can be a bad idea, but I think that a lot more nuance is necessary. So let's start at the top, this idea of short-termism. I'm going to define short-termism as a tendency to make decisions that appear beneficial in the short run at the expense of decisions that have a higher payoff in the long term. And this tends to come in 2 flavors. The first is investor short-termism, and the second is managerial short-termism. Now, it's easy to find tons of concerns about short-termism throughout history. I have examples that go back decades, but I'm just going to give you a quote from the Harvard Business Review that I think very much captures this feel. And the quote is open, the shadow of short-termism has continued to advance, and the situation may be getting worse. As a result, companies are less able to invest and build value for the long term, undermining broad economic growth and lowering returns on investment for savers, right? So this sounds pretty draconian. I want to look at a few aspects of this. The first one is why the shortening of time horizon may actually be justified on some economic facts. So for example, consider the rate of diffusion for new technologies and go back in your history books. It took 71 years for 1/2 of the US population to get access to a telephone. It took 18 years for half the population to get a color television, 10 years for internet access. All these diffusions speed up, the rate of change speeds up, things become a little bit more short-term oriented. Another interesting one is asset lives. So this is what the accountants put on the balance sheets. The asset life for technology is about 6 to 7 years. Energy, industrial is more like 17 or 18 years. And as the composition of the economy has shifted, and the stock market has shifted from asset heavy to asset light, the weighted average asset life has shrunk substantially over the past 30 or 40 years. So there is some justification. You're a CFO, you now really have a shorter period of time given your asset life to get a payback. But the most fundamental way to assess the market short-termism is to look at asset prices themselves. It's easy to find pundits that suggest the stock market is overvalued. This notion, of course, is backed by evidence such as the CAPE ratio. That alone, by the way, should give pause to those who argue for short-termism, right, with high valuations. Because high valuations mean the market is recognizing and paying for cash flows many years into the future, and that's the very, very opposite of what short-termism suggests. Now, here's a very simple example I do with my students at Columbia Business School. I just take 5 stocks from the Dow Jones Industrial Average, I look at the dividends that they're scheduled to pay over the next 5 years, and I discount them back to a present value. If you do that calculation, that comes up to about 11% of the value of the stock. So saying that differently, roughly 90% of the value is for cash flows beyond 5 years. Now, if you say, well, what about buybacks? Add the buybacks, you still get about 80% beyond the next 5 years. So in other words, just mathematically, you can see the market's paying for many years of long-term cash flows. Perhaps this is, I think, also not well understood. Perhaps the most popular argument for short-termism is the holding period of money managers. For example, Michael Porter, the great Michael Porter, in a report called Capital Choices, noted that the average holding period for stocks has declined from over 7 to 8 years in the 1960s to something much shorter today. And he said, it is perhaps the most telling evidence of shortening investor horizons. Porter is indeed correct. Portfolio is much lower than it was in the 1950s and 60s, but you might ask, why is it so much shorter? Now, if you examine a long-term chart of portfolio turnover for active managers, you're going to see a spike starting in May 1st, 1975. And for those that are students of the market or have been around for a while, you know exactly what that day was. That was a day that commissions on stock trading were deregulated. To give you some sense of the situation, and by the way, in the world where you can now trade for free on Fidelity and E-Trade and Schwab and all these other things, the cost to trade 10,000 shares of a $40 stock was 43 cents per share on each side of the trade, in and out. 43 cents per share. That was regulated. And of course, the spreads, bid-offer spreads were in eighths, so the cost of trading was vastly higher, right? That's going to limit activity a lot. Further, turnover is actually down substantially in the last 20 years. Our latest reading, now we get the Morningstar data, and we only have about 2/3 of the mutual funds in, so we don't have full 2019 data. But we have now the asset-weighted turnover is about 20 to 30%, which is the lowest we've seen since the 1970s. Now, there are obviously entities that trade a lot, and that's mostly because the cost of trade has come down so much. In fact, index funds, Jack Bogle came up with the idea, the idea had been around since the early 1970s, but it wasn't viable until after 1975 because the costs to transact were vastly too high. So the trading costs have created some flexibility. So that's the first point. I'll just say, I'll finish this with a couple thoughts. First is I recognize that managers and investors feel pressure to deliver short-term results. By the way, all of us that seek to have successful long-term careers, we also feel short-term pressure. I suspect Jason has deadlines for his articles and so forth, and that's because the long term is an aggregation of short terms, right? So the key is obviously to do the right thing day in, day out. And the last thing is the reason that investor holding periods are shorter than the number of years that are reflected in stock prices is that investors make essentially short-term bets on what are long-term outcomes. If you want to understand the market's time horizon, do not look or talk to investors. Look at what the market does. So short-termism, number one. The second one, and I think people find this one surprising, the second myth is about the role of dividends in capital accumulation. In a paper, by the way, with Rob Arnott, the great Peter Bernstein, who, again, I revere, here's a direct quote from that paper. The data of this paper put the lie to the conventional view that equities derive most of their returns from capital appreciation, and that income is far less important, if not irrelevant. BlackRock put out research that was even more emphatic, stating, and this is open quotes, some may be surprised to learn that 90% of U.S. equity returns over the last century have been delivered by dividends and dividend growth. Yes, I would be very surprised, especially if that were true. Now let's just take a step back. The reason we save or defer our current consumption is so we can accumulate capital in order to satisfy future liabilities, whether it's putting a kid through college or retiring comfortably. When we discuss the stock market or specific stocks, we tend to often refer to total shareholder returns. We often look at historical total shareholder returns for guidance as to what they'll be in the future. And of course, total shareholder returns assume dividends are reinvested with no friction at all. So there are two, I think, confusions that arise from this. The first confusion is that almost no one earns the total shareholder return. For you to earn the TSR, you have to have an automatic dividend reinvestment program and zero taxes. The number of people who fall into this camp are really de minimis. Most people either spend their dividends they receive, which obviously is utility, so that's great, and most funds simply take that money and put it into their cash balances and redeploy it elsewhere. And by the way, also true for pension funds and so forth. So you have to be very, very careful when you rely on past TSRs to plan or think about the future. The second, and this is sort of the heart of my argument, is dividends and reinvestment dividends are, this is the myth, is that they are the main driver of investment performance. In reality, and let me say this slowly, price appreciation is the sole source of investment returns, that increase accumulated capital. Price appreciation is the sole source of investment returns that increase accumulated capital. Now, to understand this, just to slow things down a little bit, right? Say you have a $100 stock that pays a $3 dividend. The day they pay that dividend, what are you going to have in your portfolio? You're going to have a $97 worth of stock and a $3 dividend, right? So that'll add up back up to 100. If you assume you're going to get a TSR, what you're going to do is take your $3 and you're going to reinvest it back into the stock. So you're going to take your stock balance from 97 back up to 100 by reinvesting your dividend. So you're going to pretend I never got my dividend. I'm just going to buy more stock to top myself off again. Just that little discussion alone should make it clear in your mind, right, that it is price appreciation that is the driver of accumulated wealth. Right? It has to be if you think about it mathematically. So capital accumulation is how much you invest, how long you invest, and price appreciation. By the way, there's a lot of confusion about buybacks. I won't talk about buybacks. We're going to do a whole 5 hours just on buybacks, but the confusion on that I find to be mind-boggling. Now, I will say there is one relationship I do want to just note and acknowledge, that we see a lot of work in finance, that there is a relationship between rapid asset growth and poor total shareholder returns and slow asset growth and sometimes asset contraction. So in other words, it's hard for companies to deploy capital, but that's a slightly different point. Now, here's my last point. It brings back to Peter Bernstein. So much of what I just discussed was summarized in a paper that was written by my collaborator and my mentor, Al Rappaport, and was published in the Journal of Portfolio Management in 2006. So, of course, Peter Bernstein had written this thing about how important dividends were, so Al sent him a copy of the paper, which is great. And of course, Peter was one of the founders of the Journal of Portfolio Management. And it was a beautiful exchange because Bernstein wrote him a note back, and he said, I am completely persuaded by this argument. I've been thinking about this wrong for years and writing about this incorrectly for years. Thank you for correcting that. Bernstein was 87 years old when he wrote that note back. And that is an inspiration, and that's why I want to be him when I grow up, right? That is an inspiration, that he was open-minded and learned from that exchange. The third myth has to do, and there's a lot of fascinating data here too. The third myth has to do with companies that lose money. The Wall Street Journal reported that 74% of companies that did an IPO in 2019 lost money. And that's about the level where we were in 1999, which is obviously near the peak of the dot-com bubble. Further, about 40% of listed companies in the United States today lose money. And again, all against a backdrop of a very solid economy and so forth. So the implication is that things have returned to sort of a frothy state. And by the way, those fears have been fanned by the big debacles like the WeWorks of the world and so forth. Now here's a short quiz for you, and I want you to think about this carefully. What if I offered you shares of a company that just listed on the New York Stock Exchange, and I told you with absolute certainty that they would have negative free cash flow for each of the next 15 years? Would you want to buy that stock? And what would be your thinking? Just listed, I can tell you with absolute certainty they will have negative free cash flow for 15 years in a row, every single year.
I would think it's Amazon.
Amazon's had positive free cash flow, by the way, not negative free cash flow. It's actually a precursor to Amazon. It's a company called Walmart. 1972 through 1986, Walmart generated total shareholder returns of 33% versus 11% for the S&P 500. Walmart had negative free cash flow for each of the first 15 years, and I think it actually went on a bunch of years beyond that. Had you invested in Walmart shares when you had that, and I'm telling you, absolute certainty negative free cash flow, you would have earned, your capital would have accumulated 15x what you would have earned earning the S&P 500. Why was Walmart such a good stock? And the answer is, of course, they earned very high returns on the investments they were making. Their stores were fantastic. And when companies may have high returns on investments, you want to invest as much as you possibly can. And they did a lot of that. So they're investing more than they earned. They had negative free cash flow, but of course, that's fantastic if you want to build wealth. So what does that have to do with what's going on now? Well, there's been a watershed change in the form in which companies invest. In 1977, tangible investment was double intangible investment for corporations. Today, intangible investment is 1.5 times tangible investment. Now that's for many of our investment careers, we've seen much of this change. Tangible investments, to state the obvious, appear on the balance sheet. Intangible investments tend to appear on the income statement. They're in sense that they're expensed. So what's the solution to this? The answer is do an apples to apples comparison. You have to capitalize those investments, put them on from the income statement back onto the balance sheet. When you do that, two things happen. Of course, income goes up and capital goes up, right? Just mathematically. So this also relates to why this has been a very challenging time for value investing, right? Value investors tend to build portfolios based on price to book or price to earnings. Baruch Lev at NYU, by the way, wrote a beautiful paper about value investing over the summer. I recommend it to you, and it's got a lot of pictures, which is easy to read. And he made these adjustments, and he found that 40 to 60% of the stocks that were categorized either as glamour stocks or value stocks shifted categories. So a more accurate reckoning for what was going on actually reshuffled the deck in a fairly meaningful way, and more importantly, he found that those adjustments led to vastly better signals for building portfolios. So you can see there's this distortion that's going on as a consequence. This also addresses the concern that companies are underinvesting and returning too much capital to shareholders. If investments from the income statement are properly categorized, firms have absolutely been increasing their operating investments over time. So so people worry about CapEx going down, R&D's been going, you make this adjustment, that pattern has, investments have been going up for sure. Now, I believe this myth has created enormous opportunity for investors who are willing to get down and dirty to understand unit economics. If you knew how good Walmart store economics were, you would have stood behind them and applauded as they spent all that money and had negative free cash flow. Likewise, some companies today are losing money but have extremely attractive economics. Others are losing money and have extremely unattractive economics. They're losing money the old-fashioned way. So those companies, those investors and analysts who understand the distinction between those two things, I think stand to make a lot of money going forward. So I have more myths and delusions, right? But I think that the impact, and by the way, one of them is on the impact of active to passive. Steve mentioned the paradox of skill, but I will stop there. Look forward to our continuing discussion and questions.
You have a question? Yeah, go ahead.
Yeah, I do. So after Michael was here, we were here 15 years ago. This is in the wake of the tech crunch, collapse, bubble bursting, and there was a collective madness of the crowd. So there was this notion at the time that the crowd was insane. People lost all their rationality. And that's what we believed until you came and you said, and I'm not sure whether it was you said it first or James Sawicki said it first, the crowd is usually right. You said something like, the crowd is usually wrong only 5 to 10% of the time. Sawicki said the crowd's usually right if it's diverse, if it's informed, and there's an aggregating mechanism, right?
Incentives, too.
And there's an incentive to be right all the time, or 90% of the time. Okay, so I'm thinking, and then we had a session here about 3 years ago with on passive investing, right? Charlie Ellis, declared that active investing is dead, and that why bother? Price discovery is almost perfect. So they said at the time that the head of Exxon's pension fund said, we're completely indexed. We're completely indexed. We've been indexed. We're beating the pants off of everybody, especially the people with the private market portfolios. And someone said, yeah, well, what if the whole crowd goes into passive, and then we start to fall? So I'm actually thinking that the crowd is not always right. Because if the crowd is all into index funds or passive investing, or they're all in the same investments, has the pendulum swung the other way? Is the crowd getting insane?
Am I allowed to take a swing at this? Yeah.
Yeah.
Well, I mean, I think, first of all,
the one who said it.
I'm actually very interested in all this stuff we've done a lot of work on active to passive, and it's a fascinating topic. And by the way, I work for an active manager, so, obviously full disclosure on this. Okay, so let's just state the obvious, that you cannot have 100% indexed, right? Because active managers do two really important things. They encourage price discovery, and they provide liquidity, and those are important societal goods. And also be clear that indexers, and by the way, I own a lot of index funds in my own portfolio, indexers are free riders. So the fees that are getting paid to active managers to encourage that price discovery essentially are subsidizing Vanguard and Fidelity and BlackRock and all these guys, right? So let's just be super clear. The question now becomes, and we're not going back to 100% active, I have to state the obvious too. So the question is, as this pendulum has swung from all active toward passive, at what point is there an equilibrium, in quotation marks? So I find the most compelling way to think about that is the Grossman-Stiglitz framework, right? In 1980, Sandy Grossman, Joe Stiglitz wrote this paper called On the Impossibility of Informationally Efficient Markets. And the argument was, markets can't be perfectly informationally efficient because there's a cost to gathering information and reflecting in prices. And as compensation for that cost, there should be a requisite benefit in the form of some sort of excess returns. Now, you could argue in an equilibrium system that those costs and those benefits should be equal to one another, right? But there always has to be some inefficiency, otherwise to get people to try, right? So how do you think about these things? And I think the cartoon version of what happened in the world is that efficiency happened faster and fees were lagging. So people were paying too much for something. And I think this one manifestation of that is people going to indexing has been, been a very good thing because it's just gotten the cost. But there's always going to be that component to some degree, and I think that's one way. So whether that ends up being 80% indexed or 90% indexed, and I think, Charlie, you could all debate that. But I think we should be able to put some rough numbers on this to some degree, how much available alpha there should be to do that. Yeah, so that would be the, I think, the broader thought on that. The other thing I'll just say on this, which is interesting, is we do a calculation, and I shared this with my students last night in class. We do a calculation where we look at the standard deviation of alpha. So imagine alpha is a bell-shaped distribution, right? It's not exactly right, but close enough, right? Positive alpha, negative alpha. The premise is if you're an active manager and you're the smart money that doesn't exist, you're going to be over here, right? And you're going to take the money from the dumb money, right? So the question, if you're an active manager, do you want a fat bell-shaped distribution or you want a skinny one? Right. Fat is the answer. Here's what's happened in the last 50 years. It's gone straight like this. Right. It blew back out around the dot-com, by the way, when mom and pop came back into the market to be fleeced, right? Then they wisened up and got out again, and then it's gone right back to trend. Although interestingly, in the last few years, we've actually seen the trend blow out just a tiny bit. So, I think that it fails the macro consistency test. Not everybody can index, right, to state the obvious, and you're free riding. But for most people, right? Now, the other thing, you mentioned the paradox skill. The other last comment I'll make is, it was actually my fourth myth, my bonus myth, which was, and I have a great quote from Seth Klarman, who I love and I deeply admire. But I hear from people from time to time, and I heard this at a dinner just a couple weeks ago from a very good active manager, this index thing is awesome because it's going to make my life so much easier. And I'm like, here's the problem with that. Today's Thursday. Let's say I say, John and Steve, I want you to come to my house to play poker tomorrow night. Do you want to come? Your first question would be, who else will be there? And if I say, a couple of really rich guys who are really bad at poker, they'd be like, I'll be right over. On the other hand, if I say to them, well, these guys happen to be a lot better than you at poker. You'd be like, maybe I'll rearrange my sock drawer. I got something better to do, right? And this is the basic argument, or this is the question I'll pose. Here's the question. Might it be the case that the people who have left the active management industry, whether that's individuals directly or subpar funds, are precisely the money that's gone into indexing? And the people that remain at the poker table are the best poker players. Your life didn't get easier, your life just got harder. And by the way, those indexers are still showing up at your house Friday night and drinking your beer, and I mean that right, because you're subsidizing them. You're subsidizing them, so you're giving them free drinks, but they're not going to win or lose any money. You're not going to be able to take their money. So that's an interesting question is, ask the question, has this gotten easier or harder? Depends who's left the game. And has the game gotten harder, not easier? Now again, you make the extreme ridiculous case that everyone indexes, it will get easier again, but it's hard to argue I mean, I debated with Charlie about this, like, because I think he's just like, it's becoming religious. And it's not religious. The answer is somewhere in the middle, right?
That's
But
Charlie.
no, that's great, and he's great. So I had a lovely, he's another amazing guy.
Yeah.
But
Let me ask Kurt Schuck, how many CFAs are there in the world?
no, there are a lot.
Two.
160,000.
160,000, and primarily equity analysts?
No, maybe 25% of those people are actually in investment management, and the others get the CFA to be in other parts of finance. But there's a pretty active slice of the CFA membership that are doing this active management work, and obviously it's something that we're quite concerned about, just in terms of are we teaching skills that are still going to be useful in markets.
Yeah.
What's going to happen with active management for certain.
Ted?
This is a question for Jason and Michael. Michael, one of the papers that you wrote in the last few years that surprised me because it both felt like a myth busting and that it didn't seem to get a lot of attention was this question of if you measure the success of active managers or the failure of active managers a slightly different way, you render quite a different conclusion. And so, Jason, I don't know if you know about that paper, but I would love to hear your view. And so the paper basically measured active managers. Why don't you describe that?
Well, I love that. We're going to update a lot of this stuff. So that paper, if I'm getting this correctly, correct me, Ted, if I'm getting this wrong, but that's based on the Birkin Green work. So Jonathan Burke and Richard Green. And what they argued was you should be looking at investors the same way you look at a company, like there's this economic value add or economic profit, same basic concept. So the formula here is you take pre-fee alpha, right, so it's risk adjusted, but pre-fee alpha times AUM. So that you're doing a dollar calculation, and rather than thinking about a ratio, you're thinking about how many dollars are extracted from the market. So when we talk about X number of funds outperforming or underperforming, it's, whether you run $100 million or $100 billion, they're all counted the same. But of course, in reality, that's nothing, that's ridiculous. And we give an example, an illustration, I think makes it quite vivid. Well, I got it from those guys. But when Peter Lynch was running Magellan the first few years, he had insane alpha, like insane, but he was running a tiny amount of money. So his value extraction was actually quite low, right? He's playing at the low stakes table. And then he went, in the last 5 years of running Magellan, his alpha was still positive, albeit like 1/10 of what it was in the early days. But he was running a gargantuan amount of money. So his value extraction from the market, dollars, was vastly larger. So it's this concept of thinking about total value extraction from the market. And again, we typically do it pre-fee. Now, if you introduce, so we have the numbers back, and some of these things are rough because it's a Morningstar database. We have thousands of funds, but not all of them and so forth. But we do this for equities, and you find that value add is roughly equivalent to fees. So net, active management has basically been net zero. And again, this is all asset weighted. That's the key thing to bear in mind. It's all asset weighted. Jason made a point about everyone, obviously fees are important. Turns out, why has capital done so well over the years? Capital research, they're big, but their fees are lower, right? So they were really good investors with very reasonable fees. Interestingly, we did it for fixed income, and there actually active adds quite a bit of value. And we're doing it versus benchmarks. That's the problem. You're doing it versus a benchmark. So I think that's the whole. That was that discussion. And it casts everything in a very different light because you're now asset weighting things. You're thinking about things pre-fee. And again, fees are, by the way, this may be another myth, right? Because people talk about this. Has anybody actually done the correlation between alpha and fees on a fund? There is no correlation.
Did Morningstar do something?
No, it's wrong. Look at what Morningstar did. So what you end up doing, on average, it's obvious to state the thing that higher fees tend to lead to lower returns. That's true. But if you just run a scatter plot on this thing, it actually there is no correlation. So the only way to do that is you start to do quintiles or quartiles or something like that. But read the Morningstar thing very, very carefully about how they explain that. So we ran that number, and I was like, we wrote a piece called "What Makes for a Useful Statistic," and it's basically what's predictive and what's persistent. So persistence is just reliability and reliability in statistics, right? If I know the fees last year, do I know the fees this year? So that's highly persistent, right? The fee structure. And then we did, does it predict alpha? And the answer is it basically had very little predictive value whatsoever. So I think that people don't perceive that. So these are all just things you just start to play with the numbers and you start to see that. Now, do I believe that lower fees on balance are better than higher fees? Of course, right? But that relationship is not like a little simple, put a bow on it, simple relationship. So I think there's a lot more. So I recommend, so this guy, Van Binsberger, do you know this guy from Penn? How do you pronounce his name?
Jules yes,
Okay,
something
Robert, yeah.
like that.
So this guy,
Jules.
and by the way, I'm happy if anybody wants to send me a note or whatever, happy to give, I like all this stuff has tons of references behind all this stuff, happy to share all that stuff. But Jules Van Binsberger at Penn and Burke, those guys have continued this thread of research, and they've got they're beautiful papers and they're cool and they're very different than, they're good myth busting stuff.
Great. Thank you, Michael. Other questions? You have Sue.
So, switching back to the private markets, if you could, Victoria, I haven't read your book, and it sounds like I should. But I understood what you were saying. I heard two things that I think maybe are worthy of further discussion. One is you referred to risk-adjusted returns. And I think there is a commonly held perception that private markets are riskier than public markets. But what if they're not? And it's very hard to measure risk in private markets. So is that a myth that we should think about, that maybe private markets are not riskier? That was the first point. And the second point, if I heard you correctly, you were talking about different metrics that you could look at to help determine whether or not this is a good time to invest in private markets. And that perhaps because there's so much money going in, that maybe it's not as good a time. And I guess my own experience over a number of years is that the amount of money going in is an interesting metric to look at, but never really correlates with returns at the end of the day. And there are factors that are, I think, more important in determining how you're going to do. For example, 2007 was a huge year for fundraising, and then we had the downturn, and some of those funds are only now, distributing, and they're great funds. So you would have said, oh, there's too much money raising, fundraising, much more than they had in the past in 2007.
Right.
So over the course of my 30-plus years in private markets, almost every year there was someone saying there's too much money in the business.
Right.
Very few years where people saying there isn't too much money. So, and yet the private markets continue to generate good returns.
Right. So let me start with the first point, and these are very good points. Should we think about private asset classes as less risky? So again, I find it very hard to just bulk it all into alternative asset class and opine on the risk of that. Even if we just go straight with venture capital, gross equity, and buyouts, the source of risk in
Victoria,
those.
how do you define risk? Let's define risk.
Yes,
Let's have a universal.
I'm
yeah.
getting there.
Yeah.
So,
Problem.
right.
Yes,
So,
we should.
so it's the source of risk in those will be very different, right? If we think about the buyout space, so now to the definition of the risk. So the underlying fundamental, you would need to believe that somehow the buyout industry has some bias as compared to public market, that they're somehow concentrated in particular type of industries. And even though over time they've been clustering and there've been trends in the industries, I mean, it's largely a representative portfolio. If you walk into any large private buyout company, there will be experts specializing in all of those segments. Sometimes they take bets. So from that perspective, from fundamental, and risk, of course, I'm an academic, so it's defined as data.
Yeah.
And then you can run a multi-factor model if you wish. So from the fundamental perspective, that's a representative portfolio, more or less, changes slightly over time. Sticking with the buyout industry, then it's unambiguous that having higher leverage increases your risk. That's just ultimate truth, right? So if you take a representative portfolio and lever it up twice the leverage in the public market, then the answer is unambiguously that it's on a non-risk adjusted basis. That, I mean, if you factor the leverage, then that's a risky asset class. Buyout is a risky asset class. Venture capital or growth equity, separate story, right? And the source of risk there comes from a different place. So that's to the first point.
And that's where my experience is.
Yeah. Yeah, so on the second point, whether there is always people talking about is too much money. Now, in a historical perspective, it is the case, and there are studies that show that when there is a large fundraising, it's subsequently followed by lower returns. And the way to think about, but I think that this is where maybe I wasn't fully clear. I'm not saying that this is a wrong time to enter into private asset class, and this is where I was trying to differentiate myself from Jason. I did say that I completely think about this as a, well, I said that it's a superior asset class, quoting Jason, but the reality is that it's a different asset class, and the way you approach it is as a diversified portfolio. Should you be investing in this asset class? Well, it has a different profile, a different source of risk, a different source of value add than the public market or fixed income or whatever else you might be holding, right? So in that sense, there is always a place for it in your portfolio, even if you are a passive investor thinking about it just a portfolio perspective. What my critique was is about, then there is an additional point to that, that the investors that go after an asset class are just by value-weighted composition is primarily pension funds, endowments, sovereign wealth fund, family offices. Well, that horizon is completely different. There is an additional reason to invest in this asset class. It is from the structure of your comes from the structure of your liabilities. You shouldn't be investing in some. There is no value for you in liquidity. You shouldn't be paying for the liquidity. That's another point, right? So just between the fact that this is a different asset class and you have no value of liquidity, that alone should push you into this asset class. The point that I was making is how the pensions think about this asset class. And my concern was that it's a very naive approach where they're benchmarking, they're expecting the history to repeat itself. But it's already not repeating itself. You can say, no, but look at all these amazing deals that are being exited right now. And of course, the market is booming, and anybody who's exiting right now is doing great. But if you are pension funds, then you have to factor in the fact that half of your money is not being deployed to start with. So the average return on that is not that amazing, actually, right? So that's my point, and that the expectations of the pension funds that seem to be reflected in their enthusiasm for the asset class are more in line with the historical profile of returns, which is not to say that the returns will be terrible. That's not what I was saying. They will be not in line with historical returns. That's what I'm saying.
Victoria, let me ask you, but and this may be Jason too, it seems to be a psychological component of this too, which is just literally the marks these funds get back every quarter on their buyout. It just seems the marks are less volatile than public markets.
They have to be. Where is it coming from, right?
So someone's market, so that seems to be like a huge, so when we talk about, that's why I asked about risk, like how do we measure that? And we typically do volatility, but we're saying like the marks themselves seem to be, it's more muted than public markets. As a consequence, people feel better that they have this thing, and you know their performance is not hit as much, and so on and so forth.
No, I mean,
again,
this is an important point, is that this is an asset class where some of the metrics that we are using cannot be directly applied,
Yeah.
which I think is a right way to think about it, is first start with what is a fundamental investment? Is it any different than from the public
Right.
market? Are you levered or you are not levered? Do you
Right.
have the same information or you
Exactly.
don't? That's the way to think about it.
You know, from a governance standpoint, a lot of people have said that for committees, it saves them from themselves because they're unable to trade when when the crisis occurs.
Precisely.
And if barring a liquidity crisis or liquidity squeeze, that's true.
Exactly.
You've got 15, 20, whatever % in private capital, and you've got to, you've got to go elsewhere to sort of exercise your anxiety. But anyway, further questions? Yes, Kurt.
Or for Victoria, what do you make of the fact, so we have unprecedented demand for private investment from professional investors. What do you make of this notion that we should open this market up to retail?
So, I think that making, so I'm going to My short answer is yes. And the United States wouldn't be even the first one in doing so, right? I mean, the pension funds in Europe, defined contribution pension funds in Europe are open to the alternative asset classes. Now, it is a very complex problem because one of the problems that the defined contribution faces is the fact that they are runnable, unlike a public pension fund where the money is locked in, right? Because you can choose between your Vanguard's Fidelity and you can move your money. And so that's a little bit in a conflict with a structure, with the asset class that you are pursuing. So it is a very complex problem. Of course, there is also the J curve and all of that. But it's done. So it's possible to do it. And there is no, when we look at Europe and defined contribution is open, to the alternative asset classes, and in the US it's not, this is difficult to reconcile. And then there are, of course, good points like, okay, well, if the private equity, if the private asset classes continue to grow, and partly that eats public market and public market shrinks, and there gets into another point of, is it even fair to restrict the public investor from accessing alternatives in any other way because their universe is shrinking and they don't have access to this other asset class that is only accessible for family offices and endowments. So, but one concern that I have is why lobby for it now? So why is the precise moment? So you look at it's not that the private equity industry it's a good point and I completely endorse it, but I'm a little bit worried about the timing of it. So, because it's not like there is lack of capital in the private industry, right? There is tons of it that is not being deployed. I'm a little bit feel like this is an industry setting itself for farther future where they might need those sources of capital, and this lobbying for let's do it now is a little bit the context of where we are in the market, where we are politically, and so it's a yes. I think that there are enough sophisticated players that can execute correctly. I'm a little bit, I think the timing of it is self-serving from the private equity industry, but that's my view.
Yes.
I have a myth for you. The myth is the passive investment actually exists. My point being that if you select the S&P 500 as your benchmark, that's an active decision what benchmark you're going to recognize. But you're ignoring fixed income, you're ignoring private markets, you're ignoring farmland in Bangladesh, the curry shop in London, or craft boat in Alaska. All those economic sources you can't invest in. They're not very efficient. The other point being is this maybe the benchmark or the index should be whatever liabilities you take.
The other, 2 or 3 years ago, we said, don't be fooled because passive really is quite active management of the benchmarks. It's not good.
Well, I wouldn't disagree. Certainly, the choice of passive or active is obviously an active choice on the part of the chooser, and many indexes are themselves have an active component in the sense that some committee has designed them with some metrics in mind, and from time to time that necessitates changing the index. Certainly the S&P has changed over time, including in the late 1990s, actively choosing to add a lot of technology stocks. But I'm not sure where we go with that. Does that help us determine whether what's conventionally called active and conventionally called passive are the better choice for a given situation? I'd have to think that through more.
I mean, to me, and I also agree with that. It just seems to me there are two decisions. You have your asset allocation decision, to your point. Do you want, farmland or whatever? And then the question is, once I've got that determined, how do I best express those views?
Yeah, how do I execute?
How do I execute? And so then you'd say, well, does it make more sense to be indexed or something? So there is no pure. Charlie hates this term passive, and I agree with him to some degree. It's an index. It's a low-cost replication. Most ETFs are just rules-based strategies, so they're algorithmic strategies. but they're all, someone wrote down the rule, right? Or someone wrote down, like, there's a committee at S&P that decides what's in the S&P 500. Humans are behind all this, but the question is, if I want exposure to this asset class, what is the most appropriate way for me to access that, or whatever, to satisfy my long-term goals?
Yeah, right.
Right, so this kind of draws on a topic that Bill and I have been talking about for a long time, and that is the point that you alluded to. I guess that a myth might be that emerging markets equities offer a risk premium, and number two, emerging markets equities offer diversification. I'd be interested in the views of the panel.
Well, in case anybody didn't hear the question, it was sort of, is there a risk premium in emerging markets, and how significant is the diversification value? I think the simplest way to think about this, and Elroy Dimson and his colleagues have written very well about it, I think, is that it depends, it's all a question of relative valuation. I mean, if developed markets are expensive on a multiple basis relative to emerging markets, then emerging markets probably offer a prospective risk premium at that point. And if not, they don't. Today, most people whose views I follow say there still is a premium, but it's quite small, because virtually all publicly traded assets are expensive, as arguably many private assets are as well. There's just so much cheap money sloshing around. Prices of everything have been driven up. Diversification is a more interesting question, and I think the underappreciated element here is sector. There can be very strong sector effects when you diversify across developed and emerging markets. I mean, emerging markets are obviously extremely heavy in, you know, the extraction industries, mining and natural resources. Also very heavy in, you know, financials as a general rule, and then very light in a lot of the industry sectors that drive the S&P 500. So I think maybe looking more from a sector perspective can add a little depth to the analysis.
I will say, I mean, as I mentioned, I taught my class last night. We actually ran all these numbers, and I'll just give them to you. So this is emerging markets over the last 20 years. These are all over the last 20 years of data, right? So we try to capture not just the financial crisis, but going back before that. Emerging markets return 7%, risk in this standard deviation 31.2, pardon me. World equity, so this is just a big bucket, 5% returns with 19.4% standard deviation. And then U.S. large cap, 6.3% returns and 18.4% standard deviation. Right, so you can do like a little back of the envelope on your Sharpe ratio or something. So it's much lower, but you can see that the risk, you know, the volatility is substantially higher. So you could debate whether that's legitimate or whatever, but that's empirically last 20 years. That has certainly been true. So you say risk premium versus some sort of, you know, benchmark, whatever. It seems like there is still something there.
Right. Look, Ryan, you had a question.
Yeah, I think it'd be remiss not to talk about the madness of crowds. We can talk about the wisdom of crowds, but Dave, specifically to you, in this room we've many times heard crowded trade, people on one side of the boat. You're doing a lot of journalism and talking to a lot of the active participants. Are you seeing areas where there is a madness of crowds?
Well, I guess the older, that's a good question, thank you. I think the older I get, the more skeptical I become of anyone's ability to identify that. And look, I lived through 1999 and early 2000, as I'm guessing most people in this room did, from the look of the audience.
73, 4.
Yeah. John, yeah. 1929, right, John?
There you go. You got it.
And that really felt mad. Oh, we can debate whether it was, but today I think it's a lot harder to say. I guess I would reframe the question, and I would say, do I think that people who manage pools of capital measured in units smaller than billions are wise to be rushing into private markets? No. I think that is madness, because I don't think small pools of capital have the throw weight that they need to capture whatever premium might be available in private equity or other private asset classes. I think the dispersion from between the good managers and the bad is so great and so likely to be allocated to favored clients that it can be really difficult.
Can I correct that slightly?
Yeah.
It's madness to do it, to try to make allocation in the funds directly. It's crazy, super madness to try to do anything that goes to try to do private equity from your pension funds in any way. That's complete. But even trying to access fund is a madness. Now, fund of funds, that would be a separate story. So small pension funds, the funds of funds is the way to go.
I know we're out of time, and I should chip in one thing. There's Seth Klarman, who I just mentioned, who I love, has a quote on this I think is actually very reasonable, practical guidance. And he says, value investing, forget about it, value. Investing is at its core the marriage of a contrarian streak and a calculator. Mm-hmm. And I always love that. So the contrarian streak says if everyone seems to believe something, you should absolutely examine the other side. This goes back to what, so, but the fact is, don't be a contrarian for the sake of being a contrarian, because the crowd's often right? When the movie house is on fire, by all means run out the door, right? But the calculator piece, I think, is really important. And that says, because everyone believes something, the set of expectations now priced into that asset class or that stock or whatever it is are just unrealistically optimistic or unrealistically pessimistic. So what has to unfold in the future to justify what you're paying just doesn't make any sense. So I think it's the combination of those two things, to be vigilant about examining the other side of the case when people seem to be, a consensus falls on some certain topic, but then say, does that mean then the stock has become mispriced, and or the asset class has become mispriced? So I think that's a very nice little way to think about that, combating that madness or crowd.
Thank you for defining the variant perception at the end of the day here. So I want to thank the panel. Please give them a round of applause. Thank you. Great. Steve, housekeeping?
Housekeeping time. Okay, so while I'm talking, if you would, please fill out your speaker card so we can let them know how they've done. Also, if you would, add on there any topics that you would like to see that we haven't covered already, and you know the drill. Okay, so on April 23rd, Ryan is putting together a topic for us on one of our favorite subjects, compounding. Don't miss it. So thank you, Ryan. That's in the works right now. And for those of you who got the newsletter, there was a photo page in the back. I don't know if you all saw the photo page. You're probably in there. But there's one particular photo that I really love. It's a picture of Joanne, our treasurer. She's holding a little pillow that says, "Show me the money." So don't forget Joanne and write a check. We're a not-for-profit. Thank you very much. And any complaints, do go to Joanne as well. So thank you very much. And with that, I do want to mention, if you did see the newsletter, we are now fully up and running. 25 years of Greenwich Roundtable sessions on YouTube right now. We're up to 72 subscribers. And so please like and subscribe. It's apparently something happens once you hit 100 subscribers or something like that. So at least just hit the you get a phone call, you get all sorts of free things. It's free anyways, but just, hit that like button and we'll see what happens. You can also see, this is we've been taking pictures here for 20 years now. So a lot of people say to me, "Steve, what are we doing with these pictures? Where are they going to show up?" Well, If you want to, go to YouTube. You may see yourself, myself with a full head of hair, and so on. So it's really very, very good. Also, some of the sessions with Michael and Peter Bernstein, I mean, they're classics. So some of the revelations that came out there, Jason, on investment committee behavior. Victoria, you talked about the folly of co-investment and direct investment unless you're, a very big pension fund with a staff on board. So all these really good bits of wisdom are embedded in there. And what I do recommend is that you, there's not much to look at. There's some pictures, but, turn it on, start playing it on your computer, and do something else. And you can listen to it. It's really quite an eye-opener. And that's all I've got to say. And again, thank you, everyone, and thank you very much, Jason, Victoria, and Michael. Thanks for coming again.
Thank you.